Welcome to The Explainer. Today we are unpacking the exact math, the common myths, and the ultimate strategy you need to know if you want to live entirely off passive dividend income in 2026. If you've ever dreamt of just kissing the 9-to-5 goodbye and letting your money do all the heavy lifting while you sleep, well, you are in the exact right place. We're going to break down precisely what it takes to build that kind of portfolio today.
Imagine waking up, sipping your morning coffee, and knowing you've got $50,000 in passive income rolling in this year without you having to lift a single finger. It's the ultimate financial dream, right? But the massive, unavoidable question we have to answer first is, how much money do you actually need invested to live off dividends forever? Let's go ahead and separate the expectation of this dream from the hard, mathematical reality.
Okay, let's dive into this, because this right here is the fundamental, screenshot-worthy formula that drives absolutely every single dividend investor's goal. And the best part? It's incredibly simple to use. You just take your desired passive income and you divide it by your dividend yield percentage. That straightforward calculation dictates your exact target amount. So if you want 50 grand, you plug that in, divide by the yield your portfolio pays out, and boom, you've got your target number.
Let's actually put this into practice, because we all learn best from real-world examples. What if you went all in on Apple stock? Well, Apple currently offers a tiny 0.39% dividend yield. To get your $50,000 a year, you would need a staggering $12.5 million invested in Apple. No way, right? Now compare that to Pepsi, which yields a much friendlier 3.8%. With Pepsi, you'd only need about $1.3 million invested to hit that same goal. The reality here is that popular tech giants rarely pay the daily bills. You need a highly strategic mix.
So let's ground ourselves in reality for a second. You aren't going to just hold one single stock like Pepsi. Looking at countless diversified dividend portfolios, the average realistic yield you can actually safely expect hovers somewhere between 2.5 and 3.5%. So, to safely generate that $50,000 target income across a diversified portfolio, you're looking at needing between $1.4 and $2 million invested. And let's be honest, that is a massive number for most people to wrap their heads around. At this point, you're probably looking at that $2 million figure and thinking, well, wait a minute, why wouldn't I just buy the stocks with the absolute highest yields out there and get to my 50 grand way faster? It's totally the next logical question. But unfortunately, it leads us right into one of the most dangerous, wealth-destroying traps in all of investing.
Consider the absolute cautionary tale of 3M. Just a few years ago, 3M was the gold standard. It was a coveted dividend aristocrat that had raised its dividend for 66 years straight. With a yield over 4%, it looked like a totally sure thing to build your retirement around. But then, in 2024, they completely shocked the market. They cut their dividend and were unceremoniously booted off the aristocrats list. 66 years of consecutive increases literally just gone in a flash.
And sadly, 3M is far from the only casualty we've seen lately. AT&T slashed its dividend by a massive 46% back in 2022. Walgreens also cut theirs recently after more than 40 years of consecutive dividend increases. The absolutely crucial takeaway here is that a sky-high yield often acts as a giant flashing red warning sign. It frequently masks a failing company whose stock price has plummeted or a business that frankly just has no better use for its cash. Remember, every dollar a company pays out to you in dividends is a dollar they are not reinvesting in their own future growth.
To further understand just how difficult this strategy really is from day one, let's look at the average American. According to recent Federal Reserve data, the median American net worth sits at around $217,000. If you took that entire life savings, the whole shebang, and threw it into a generous 5% yielding portfolio, you'd only generate about $10,850 a year, which is, nowhere near enough to actually live on.
So if it's really this incredibly difficult to live purely off dividends, what is the alternative? Well, enter Vanguard. They published a genuinely fascinating research paper titled Total Return Investing: An Enduring Solution for Low Yields, and this completely shifts the paradigm for us. Instead of focusing solely on the cash a portfolio spits out in dividend income, Vanguard argues that investors should optimize for total return, meaning you look at the combination of the dividend income plus the actual growth of the stock prices themselves. Why does a giant like Vanguard push for this? Well, it comes down to a massive hidden opportunity cost. You see, when you build a pure dividend portfolio, you naturally end up heavily overweight in defensive sectors. We're talking consumer staples, healthcare, and utilities. And those are stable, sure, but you end up drastically underweight in the massive growth sectors like technology and consumer discretionary spending. You're effectively boxing yourself out of the biggest market gains entirely just to get a quarterly check.
And this brilliantly illustrates exactly what we mean. A backtest from 2016 to 2025 comparing a Vanguard dividend portfolio against a total market blend reveals the exact cost. Over almost a decade, the dividend portfolio returned an annualized 9.43%. And yes, that includes the dividends being reinvested. But the total market blend, it generated 10.49%. Mathematically speaking, investing in the total market simply beat the pure dividend strategy in overall growth.
So how do you actually apply this to your own life? Well, we've laid out a clear strategic roadmap based directly on the math. Step 1, if you're under 35, your core priority should absolutely be growth. Step 2, as you hit your late 30s, you can start gently shifting, maybe 5 to 10% of your portfolio, into dividend ETFs like SCHD or VYM. And step 3, as you hit your 40s, 50s, and actively approach retirement, that is when you scale up those income-generating assets to 15, 20, or even 50% of your portfolio to create that safe, reliable income stream.
Let's zoom in on that first step for just a second. If you were a young investor, chasing dividends can actually hold you back immensely. Think about it. A beginner's $10,000 portfolio at a 4% yield only gives you $400 a year. That $400, it isn't moving the needle on your financial freedom. It might just buy you a few extra lattes. When you're young, you have literally decades to recover from market dips, meaning you can afford to take on more risk. You absolutely must prioritize compounding growth to build up your base of capital as fast as humanly possible.
There's also a highly unique factor we have to consider for our 2026 financial environment. Right now, a standard dividend stock yield of around 3% is basically completely comparable to what you can get from a high-yield savings account or treasury bonds. The huge difference here? Treasury bonds offer that 3% yield with virtually zero risk to your principal, completely shielding you from massive stock market volatility. If you just need some income right now, you can take full advantage of this current interest rate environment without exposing yourself to the risk of a market crash.
Section 1. The tax advantage. Keeping your dividends. Because let's be real, it doesn't matter how much passive income you make if the IRS just invites themselves to dinner and takes a huge chunk of it. But here is the absolute magic of qualified dividends, which are generally dividends from shares you've held for more than 60 days. If your earned income is under $49,450, your federal tax rate on those dividends is literally 0%. If you rely purely on a $50,000 dividend income and take the standard deduction, you could potentially pay zero federal taxes on that money. It's an incredible advantage if you plan it out correctly.
And hey, if you want to avoid taxes entirely, regardless of your income bracket, the Roth IRA is pretty much your ultimate wealth-building loophole. By shielding your dividend-paying investments inside a Roth IRA, you get tax-free growth, and every single dividend you receive inside that account is completely tax-free forever. It is hands down one of the most powerful tools you have to accelerate your compounding without the taxman ever taking a cut.
All right, let's bring this explainer full circle. Remember our core formula from earlier? Let's apply it with a fresh example you can take away and use today. If you sit down and decide you need $40,000 a year to live comfortably, and you build a portfolio with a realistic 5% yield, you just take $40,000, divide it by 0.05, and that equals exactly $800,000. That is your target. That's the mountain you need to climb.
But building that $800,000 portfolio requires a rock-solid plan, and dividend yield is really just one piece of a much larger puzzle. Which leaves us with this final critical thought. Do you know the 4 exact numbers you need to be tracking to actually retire early? Understanding the holistic metrics of early retirement is your absolute next step to true financial freedom. So keep learning, keep optimizing, and thank you so much for joining me on this explainer.